February 2nd, 2026. 2 silver prices exist simultaneously on planet Earth. In Dubai, 1 ounce silver coins trade at $100. On COMEX, March futures settle at $72. The same metal, the same purity, the same day. A 39% price difference. This shouldn't be possible. In functioning markets, arbitrage eliminates such gaps within hours. Buy low, sell high, profit from the difference until prices converge. But arbitrage isn't working. The gap isn't closing. If anything, it's widening. What you're witnessing isn't just a silver rally. It's the moment when 50 years of financial engineering finally meets physical reality, when paper promises collide with tangible scarcity, when the greatest monetary illusion of the modern era begins to unravel. And it started, like all great financial collapses, with something that seemed small, something most people ignored, something in Iran. Let me show you how a sanctions program designed to punish one country accidentally triggered the breakdown of global commodity markets. How China's response to those sanctions created artificial scarcity in the most undervalued metal on Earth. And how that scarcity is revealing the fundamental lie at the heart of modern finance. The lie that paper equals metal, that contracts equal commodities, that promises equal possession. That lie is dying. And with it, the entire system of price discovery that's governed global trade for generations. But this story doesn't start with silver. It starts with solar panels. Iran produces 3% of global oil, not significant enough to move energy markets dramatically. But Iran also controls something else, something the green energy revolution desperately needs: strategic positioning. The Strait of Hormuz, 21 miles wide, 30% of global oil flows. But more importantly for our story, the maritime choke point for 40% of liquefied natural gas shipments. LNG that powers the factories that make solar panels, the solar panels that require silver. When President Trump announced escalating sanctions on Iran's energy sector in January 2026, the immediate focus was on oil prices, energy stocks, geopolitical risk. Nobody was watching the silver market. Nobody except the industries that actually use it. Solar panel manufacturers consume 100 million ounces of silver annually. Electronics companies need another 50 million ounces. Electric vehicle producers require 20 million more. Industrial silver demand has grown 15% annually for 5 years, but supply hasn't kept pace. Global silver mine production peaked in 2016 at 900 million ounces. Despite higher prices, output has stagnated around 800 million ounces annually. The gap between demand and supply has been filled by recycling. Old electronics, scrapped solar panels, melted jewelry. But recycling has limits. There's only so much old silver to melt. For the past 4 years, global silver demand has exceeded new mine production plus recycling. The deficit averages 200 million ounces annually. That deficit gets filled from above-ground stocks, government reserves, exchange inventories, investor holdings, and those stocks are running low. COMEX registered silver inventories fell to 47 million ounces in January 2026, down from 180 million ounces in 2020, a 74% decline in 6 years. The London Metal Exchange silver stocks dropped to 8 million ounces, the lowest level since records began. Shanghai Futures Exchange inventories 12 million ounces, down 60% from 2022 levels. Total exchange held silver worldwide, 67 million ounces, less than 1 month of global industrial consumption. This is the foundation of the crisis. Years of deficit spending, years of consuming more than we produce, years of treating finite resources as infinite promises. Then came Iran, and China's response. January 15th, 2026. The U.S. Treasury Department announces new sanctions targeting Iran's shadow fleet of oil tankers. Standard economic warfare, nothing unprecedented. But buried in the 47-page document was something else. Restrictions on strategic commodity transfers to sanctioned entities, strategic commodities, including silver. The logic seemed sound. Prevent Iran from using precious metals to circumvent financial sanctions. Cut off alternative payment methods. What the Treasury Department didn't anticipate was China's reaction. January 22nd, 2026. The Chinese Ministry of Commerce issues a statement. Silver is now classified as a strategic national resource. Exports require special licenses, not banned, just controlled. Within 48 hours, silver premiums in Asia jumped 20%. Physical delivery delays extended from days to weeks. Industrial buyers began panic purchasing. Why did China do this? What's their strategic interest in silver? The answer connects to a much larger story: China's systematic preparation for economic decoupling from the United States. For the past 5 years, China has been building domestic capacity in every critical industry: semiconductors, solar panels, electric batteries, all silver-intensive technologies. But they've also been building something else, an alternative monetary system. The digital yuan processed $250 billion in transactions in 2025, cross-border payments with Russia, Iran, Brazil, and dozens of other countries. But digital currencies need backing. Not gold backing necessarily, trust backing. And nothing builds trust in a digital currency like demonstrating control over the physical resources that make digital technology possible. Silver is the most electrically conductive metal on Earth. Nothing else comes close. You can't build semiconductors without it. Can't manufacture solar panels without it. Can't produce electric vehicles without it. Control silver supply, and you control the pace of technological development in competing nations. This isn't just trade policy. It's technological warfare. And it's working. Within days of China's export restrictions, industrial silver users worldwide began scrambling for supply. Not next month's supply, this week's supply. Solar panel manufacturers in Germany, electronics producers in South Korea, EV battery plants in the United States, all competing for the same shrinking pool of available metal. This is where the price breakdown begins, where paper markets divorce from physical reality. COMEX silver futures are traded by banks, hedge funds, and speculators. Most never intend to take delivery. They're betting on price movements, not acquiring metal. The March 2026 contract represents 140 million ounces of silver, but COMEX only has 47 million ounces in registered inventory. That's a 3.1 leverage ratio, $3 of paper silver for every dollar of physical silver. In normal markets, this works. Most contracts settle in cash. The few that demand delivery are easily accommodated. But these aren't normal markets. Industrial users facing supply disruptions aren't trading for profit. They're acquiring inventory for survival. And they don't want cash settlement. They want metal. Physical silver, real silver, silver they can touch, weigh, and feed into manufacturing processes. This creates what market theorists call a delivery squeeze. Too many claims on too little metal. The traditional response would be higher prices. Price signals that attract new supply, reduce demand, and restore equilibrium. But new supply takes years to develop. Mine exploration, permitting, construction, production. And demand can't be reduced. You can't build solar panels with less silver. Can't manufacture semiconductors with silver substitutes. So prices rise, but not uniformly. Paper silver prices rise gradually, driven by speculation, margin requirements, and trading algorithms. Physical silver prices spike violently, driven by panic, scarcity, and the fundamental physics of industrial production. This creates the gap we're seeing today. Dubai at $100, COMEX at $72. But it's worse than just price divergence. It's market fragmentation. Different silver markets are becoming different realities. In Asia, physical premiums of 30 to 40% above futures prices are normal. Industrial buyers pay whatever it takes. In Europe, delivery delays stretch to 6 weeks, even for standard 1-ounce coins. In the United States, coin dealers are rationing purchases, 2 ounces per customer, no bulk orders. The London Bullion Market Association, the global center of precious metals trading, stopped publishing daily silver fixing prices in January. Insufficient market depth, they said. Translation, the market broke. Price discovery failed. This isn't just about silver. This is about the entire commodity complex. Because silver was always the canary in the coal mine. The most leveraged market, the most dependent on paper promises. If silver markets can break this completely, what happens to copper? To aluminum? To oil futures? What happens when industrial users lose faith in paper contracts completely? What happens when they demand physical delivery for everything? The answer is system-wide breakdown, not dramatic collapse, slow strangulation. Factories shut down because they can't source materials at predictable prices. Supply chains fragment because forward contracts become meaningless. Economic planning becomes impossible when commodity markets cease to function. This is what China understood when they classified silver as strategic. This is what Iran's sanctions accidentally triggered. The demonstration that paper markets are fundamentally unstable when physical supply is constrained. But there's a deeper story here, a pattern that connects the silver breakdown to much larger forces reshaping the global economy. For the past 50 years, financial markets have become increasingly abstract. Derivatives of derivatives, promises backed by promises. The total notional value of global derivatives is estimated at 600 trillion, 20 times larger than global GDP, 20 times larger than the entire real economy. These instruments work as long as everyone believes they work, as long as confidence persists, as long as the underlying assumption holds that paper promises equal physical reality. Silver is testing that assumption, and the assumption is failing. Look at the numbers. Global silver ETFs hold approximately 650 million ounces, more silver than COMEX, London, and Shanghai combined. But do they really hold it, or do they hold promises to deliver it? The largest silver ETF, iShares Silver Trust, states clearly in its prospectus, the trust may hold silver in unallocated accounts. Unallocated means the silver isn't physically segregated. It's part of a pool, a promise that there's enough silver somewhere to meet redemption demands. But what if there isn't? What if years of deficit supply have created a situation where paper claims exceed physical metal by massive margins? What if the current price breakdown in Dubai versus COMEX is just the beginning? The preview of what happens when confidence breaks, when promises are tested, when paper markets confront physical limits. This explains why central banks are buying gold at record rates, why China is stockpiling silver, why industrial users are panic purchasing. They understand what's coming. The great repricing. The moment when decades of financial engineering meets the immutable laws of physics and chemistry. You can print money infinitely. You can create derivatives infinitely. You can make promises infinitely. But you can't mine silver infinitely. Can't manufacture it from nothing. Can't wish it into existence. There are approximately 1.7 billion ounces of silver above ground worldwide, accumulated over centuries of mining. Global industrial demand is 600 million ounces annually and growing. At current consumption rates, above-ground silver stocks will be exhausted in less than 3 years. Not theoretical exhaustion, physical exhaustion. This is the real reason for the price breakdown, not speculation, not manipulation. Mathematics. The mathematics of finite resources meeting infinite demand, and silver is just the beginning. Copper inventories are falling. Lithium supplies are constrained. Rare earth elements are controlled by single countries. The entire material foundation of modern technology is more fragile than anyone wants to admit. More dependent on smooth international trade than geopolitical reality allows. More vulnerable to supply disruptions than financial models account for. Iran's sanctions didn't just target one country's energy sector. They revealed the systemic vulnerability of global commodity markets. China's response didn't just protect their strategic interests. It demonstrated how easily critical supply chains can be weaponized. The silver market breakdown isn't just about one metal. It's about the brittleness of the entire system. But here's what makes this moment historically significant. Here's why this breakdown matters beyond commodity trading. Silver has always been the bridge between money and industry, between store value and industrial input. For most of human history, silver was currency, legal tender, the basis of international trade. Even after countries abandoned silver coins, the metal retained monetary properties. Safe haven demand during crises, inflation hedge during currency debasement. But over the past 20 years, silver's role evolved from monetary metal to industrial necessity. Today's silver demand is 85% industrial, 15% investment, the opposite of gold. This creates a unique dynamic. Silver responds to both monetary fear and industrial panic. When currencies weaken, people buy silver as protection. When supply chains break, industries buy silver as inventory. Both forces are active now. Currency debasement from massive money printing. Supply chain disruption from geopolitical conflict. The result is price action unlike anything in silver's modern history. But there's something else, something that makes this rally different from the Hunt brothers' corner in 1980 or the speculative spike in 2011. This time, the buying isn't leveraged speculation. It's cash-paying panic from actual users. Solar companies prepaying for 6 months of silver inventory. Electronics manufacturers signing long-term supply contracts at any price. EV producers building strategic stockpiles. Defense contractors securing critical materials. This isn't trading, this is hoarding. Industrial hoarding by companies that understand their business models depend on continuous silver supply. And hoarding changes everything. Because hoarded silver doesn't come back to market when prices fall. It sits in warehouses, in inventory, in strategic reserves, waiting to be consumed, transformed into products, lost forever to recycling limitations. This is what creates permanent supply deficits, not temporary imbalances. Structural scarcity, and structural scarcity means permanently higher prices, not speculative bubbles that collapse, new equilibrium levels that persist. The Dubai COMEX spread isn't going to close by prices falling in Dubai. It's going to close by prices rising on COMEX, because COMEX prices are artificial, maintained by paper trading that ignores physical fundamentals. Dubai prices are real, set by actual buyers acquiring actual metal for actual use. Reality always wins. The only question is how long illusion can persist. In silver's case, not much longer. COMEX registered inventories are falling by 2 to 3 million ounces monthly. At this rate, they'll be functionally empty by year end. When that happens, futures contracts will become meaningless. Settlement will require cash payments instead of delivery. A cash settlement defeats the entire purpose for industrial users. They need metal, not money. So they'll abandon COMEX entirely, turn to physical dealers, spot markets, direct mining contracts. The paper market will collapse into irrelevance while physical markets set real prices. This transition is already happening. The Dubai COMEX spread is just the visible symptom. The real story is happening in warehouses, in supply contracts, in boardroom discussions about material security, Companies are learning they can't trust financial markets to deliver physical goods, can't rely on just-in-time delivery for critical inputs. They're building inventory, signing direct supplier relationships, bypassing exchanges entirely. This destroys the entire premise of modern commodity finance. The idea that paper contracts efficiently price physical goods. The idea that financial markets reflect supply and demand fundamentals. The idea that derivatives can substitute for the underlying assets they claim to represent. All of these ideas are being tested and failing. Silver is the test case, the metal where the breakdown started, but the implications extend far beyond one commodity market. This is about the reliability of modern financial systems, the trustworthiness of paper promises, the sustainability of leverage ratios that assume infinite confidence. And confidence isn't infinite, it's fragile, subject to sudden breaks when reality contradicts expectations. The Dubai COMEX spread is reality contradicting expectations, physical scarcity contradicting paper abundance, industrial necessity contradicting financial convenience, the future contradicting the present, and the future is winning.